Okay, let's dive right into this. Welcome to today's Explainer, where we're taking a super practical look at a truly foundational piece of the financial world. We are decoding IAS 34. That's the International Accounting Standard dedicated entirely to the interim financial report. If you've ever wondered how major companies manage to perfectly craft that all-important mid-year financial snapshot to keep their investors in the loop without having to rewrite their entire annual playbook, well, you are exactly in the right place. Let's get started. So, first things first, what exactly are we measuring here? An interim period is simply defined as any financial reporting time frame that doesn't cover your entire full financial year. In the real world, we're usually talking about a quarter or a half year. It's basically the bridge that fills the gap between your comprehensive end-of-year annual reports.
Here's our roadmap to decode the rulebook today. We'll hit the mid-year financial snapshot, the minimum required components, highlighting significant events, consistent accounting policies, and wrap up with seasonality and complex estimates.
The core objective of this standard is absolutely crucial. It prescribes the minimum content of an interim report, as well as the specific principles for recognition and measurement. By following these rules to the letter, companies ensure that their mid-year updates are timely, reliable, and actually useful to anyone trying to get a read on their ongoing financial health. Section 1. The Mid-Year Financial Snapshot. Think of this as the mid-season TV recap of the finance world. Now, while IAS 34 doesn't technically mandate who has to publish these reports, or even how often, governments and stock exchanges definitely do. The standard highly encourages publicly traded entities to get these interim reports out for the first half of their financial year. And the deadline? Not later than 60 days after the end of that interim period. Speed and relevance are totally key here. Remember, your investors already binge-watched that first season, your latest annual report. So to save time and money, this mid-year update focuses strictly on the new stuff. New activities, new events, new circumstances. It deliberately avoids duplicating all the heavy information that was already covered at year-end. It's an update, right? Not a rewrite. Section 2. The minimum required components. Let's see exactly what building blocks you need to construct this condensed update. You actually have a choice to make here. You could publish a complete set of financial statements, fully detailed, just like your annual report under IAS 1. But honestly, most companies opt for the condensed financial statements. It's a much more streamlined version that only requires minimum headings, subtotals, and selected explanatory notes, which saves an incredible amount of time and resources. If you do go that condensed route, you've got to include a specific set of minimum components. We're talking a condensed statement of financial position, condensed profit or loss and other comprehensive income, condensed changes in equity, and condensed cash flows. Oh, and you can't forget those selected explanatory notes. Plus, if your entity falls under IAS 33, you also need to present basic and diluted earnings per share. Now, a massive detail to keep in mind here is the rule of two. You always need two comparative periods. For example, your current interim statement of financial position, that has to be compared directly to the immediately preceding financial year-end. And for your statement of profit or loss, you compare the current interim period to the comparable interim period of the preceding year. Without that context, the numbers are basically meaningless. Moving into Section 3, highlighting significant events. What actually qualifies as a significant event worthy of telling your investors about? The standard gives us a fantastic list of major shifts that absolutely demand an explanation. Think about things like inventory write-downs, recognizing impairment losses on financial assets, or reversing restructuring provisions. Have you had major acquisitions or disposals of property? You've got to explain those. Same goes for high-stakes drama like litigation settlements or any unremedied loan defaults. These are the plot twists your users really need to know about. But on the flip side, because users already have access to your massive annual report, you can safely skip the minor day-to-day noise. Putting out relatively insignificant updates to notes you just published a few months ago, IAS 34 deems that completely unnecessary. You want to keep the focus sharp and strictly on what is material. Section 4. Consistent accounting policies. This is where the math and the theory really meet. This right here is the absolute golden rule of IAS 34. You cannot, and I mean cannot, suddenly change your accounting policies or computation methods just because it's an interim period. The rules for recognizing assets, liabilities, income, and expenses are exactly the same halfway through the year as they are on December 31st. This rule brilliantly ensures consistency. Because think about it, whether a company reports to the public quarterly, half-yearly, or just annually, the final annual financial picture cannot be affected by that reporting schedule. The timing of the report just doesn't change the underlying economic reality of the business.
So, to maintain that perfect consistency, you've got to treat the interim period as just one chapter in a larger annual book. Measurements for interim reporting are always made on a year-to-date basis. You use whatever information is available at that mid-year point to make your absolute best assessments, knowing full well those estimates might be refined by the time the full year wraps up.
And speaking of estimates, this is a super important caveat. Because you're working with a significantly shorter time frame, and let's be real, often fewer finalized data points, you have to be prepared to rely way more heavily on reasonable estimation methods than you would at year-end. Income tax is a great example of this. You recognize it based on your best estimate of the weighted average annual income tax rate expected for the entire financial year.
Finally, Section 5, Seasonality and Complex Estimates, because business isn't always a perfectly smooth ride.
You're probably wondering, well, how do we handle a company where the numbers just swing wildly based on the calendar? Imagine a toy manufacturer, right? They're gearing up for a massive holiday rush in December, making nearly all their revenue in Q4. Or an agricultural business that takes on massive harvesting costs all at once in the autumn. How does that work? Well, the standard is incredibly strict here to prevent earnings manipulation. No artificial smoothing allowed. Seasonal, cyclical, or occasional revenues like dividends or retail holiday spikes must be recognized exactly when they occur. You can't artificially anticipate or defer them just to make your earlier quarters look better. And similarly, costs that are incurred unevenly can only be anticipated or deferred if it would be appropriate to do so at the end of the full financial year.
When we talk about materiality, meaning deciding if a number or an error is big enough to actually matter, IAS 34 has a very clear rule. You judge it based solely on the interim period figures themselves. You do not base it on your massive projected annual totals. This brilliantly prevents companies from burying significant mid-year errors by saying, oh well, it looks small compared to the whole year's revenue.
Ultimately, the entire purpose of mastering all these rules is pretty simple. It's about giving your investors and creditors the timely, highly reliable updates they need. They want to judge your entity's capacity to generate earnings, manage cash flows, and maintain liquidity. And they want to do it without getting totally lost in the weeds of unnecessary, duplicated details. So, as you prepare to analyze or draft your next condensed report, ask yourself this. Are you providing a sharp, highly focused mid-season recap that highlights exactly what has changed? Or are you inadvertently forcing your audience to sit down and rewatch the entire show from the beginning? If you leverage IAS 34 properly, you're going to deliver maximum clarity with maximum efficiency. Thanks for joining this explainer, and we will see you next time.